Hi, this is Ken Brownlee with the Brownlee Group, Keller Williams, coming to you with some questions that everyone always asks for a first-time home buyer or when you're wanting to get a loan. And what I have today is Tammy. She's a buyer specialist on our team, and she's going to help ask the questions that her customers always love to know that she always has to answer. Thanks, Tammy, for being here. And we also have Mark. He's with Guaranteed Rate. Mark is on the mortgage side that's going to help answer these questions that we always get. Thank you guys for both being here. So what we really like to do is ask you some questions on what first-time home buyers may ask or what people ask. And Tammy, you are working with a lot of buyers. Maybe you can maybe ask the first question of where we're headed.
Sure. The first question is, how do they know how much mortgage can they afford? What numbers should they be looking at?
That's a great question. So basically what we do is when we pre-qualify a borrower, we try to get a list of all their income that we can actually use for qualifying. Sometimes they have multiple jobs. Sometimes we can use all their income. Sometimes we can't, just depending on how long they work for each job. So what we do is we take the gross income, and we're just talking about right now your traditional W-2 borrowers, because self-employed customers are calculated a little bit differently as far as income goes. But we take your regular W-2 borrower and we'll take their gross income. That means anything before taxes or anything like that, insurance, Medicare, anything that's taken out before. So we're actually not using their net income, but using the gross that's based on their normal hourly wage or salary. Then we determine on the type of program that they're qualifying for. Sorry, go ahead. So depends.
No, I think
type of.
When I interrupt, just keep going because there's delay. But it brings up, what about if it's a student loan? Because I know they're in default, or they're paying back the 1%. Or how would you calculate that in on the debt?
Well, again, that depends on the type of program that we're doing. So for conventional financing, traditionally anything that's in deferment or forbearance, we do have to count 1% of your unpaid balance. But for someone that might be in a income-based repayment program, then we can use whatever payment that they report to the bureaus. And oftentimes, because of COVID right now, they're automatically being put into some sort of forbearance agreement. But in most cases, if that prevents the borrower from moving forward, I would probably ask them to go ahead and contact their student loan servicing company and go ahead and put those back into repayment, because if they are an income-based repayment program of $0, that is the amount that we'll actually use for qualifying. Otherwise, we'll just use 1% of the unpaid balance, which can affect their qualifying.
Okay, and a lot of first-time home buyers don't know the difference between an FHA loan and a conventional loan.
Great. So FHA are basically government-insured products. They're 3.5% down. They are insured by the government, so they're basically, the guidelines and for the qualifying is much more lenient. So as far as credit score requirements, you can go down to 600, even below. Depends on each lender. They all have their own overlays as far as the risk of what they're willing to take on. But conventional loans are your traditional cookie cutter type of deals. You can get in those programs with 3% down for first-time home buyers, and also if certain people are within income area mean income limits, they can also get 3% down for their Home Ready or Freddie Mac's Home Possible products, which offer additional discounts for those borrowers as well. But in any case, all programs are wonderful products. Each person will have their own their own needs of what works best for them, but we're just here to kind of guide them and to determine what's the best product for them at that particular time.
Okay.
Great. So what do I need? How much money should I have to put down on a home purchase?
Well, it depends, simply because every borrower has different financial, their background might be a little different from one borrower to the next. So really just depends on what they have available to them. Normally for a first-time home buyer, in this market, it might be a little bit different, but generally we would say it'd be ideal to have $2,000 basically to start the process. So in most cases, we would say maybe $1,000 for escrow, maybe $500 for any inspections you need, and then $500 for the appraisal, just to kind of get the ball rolling. But obviously, for bigger deals that require a little bit more competitiveness, they might need a little bit more for escrow and different things like that, just to be able to make their offer look as great as possible.
I have a quick question, if I could, to tie in with that a little bit. A lot of times the appraisal is probably the last thing that ever gets done on a loan. And in today's market, we always have a appraisal contingency, or we're going over asking price. For the buyer, is there any way to change that, or is there a way to how we can address that kind of a problem, or have you been seeing much of it?
Well, definitely right now, appraisals are definitely a concern for a lot of people because of the overbidding for just to even get the deal. But oftentimes, if there is a particular borrower that's willing to put 20% down and hopes that avoiding mortgage insurance, if the appraisal does come in short, we can certainly restructure that loan to where the borrower is still able to omit the monthly cost of mortgage insurance by paying it upfront as a one-time single premium. So in effect, it doesn't really change their payment. It's just a matter of just restructuring the loan, and so that they don't have to, renegotiate a price, because in this market, we all know that's difficult.
Yeah. What is mortgage insurance for someone to ask?
Mortgage insurance, is this simply put, is just insurance in case of borrower default on the loan. There's no benefit to the borrower to pay it, but it's just insurance in case a borrower loses their job or something happens that they're not able to make their payments. It's just a warm fuzzy for the lenders to make sure that they can get their money back in some way.
So it's not benefiting the actual buyer. It's not like they get extra coverage on their house because they have to buy insurance for their home.
Correct. Yeah. Basically, mortgage insurance has no benefit to the buyer whatsoever. So if there's anything we can do to help the buyer avoid the cost of mortgage insurance, we will definitely look and try and see what we can do there.
Cool. Nice.
So a question I get from my buyers is, what's the difference between a 15-year and a 30-year mortgage?
Besides 15 years.
The biggest, right. The difference is certainly the payment. The 15-year payment will definitely accelerate your payoff much quicker than the 30-year. But generally also too, there is also a benefit of a lower interest rate. So a lot of people that are rate conscious and they have the ability to make a 15-year payment, they'll also get the benefit of a lower interest rate. There's basically the biggest points of a shorter term mortgage.
So the interest rate is less on a 15.
That's correct. Yes.
Nice.
So a question that ties in with that is, are those a fixed rate, or is that an adjustable rate mortgage?
And actually, it's a good question, because the borrower can actually choose which type of products they want, but your fixed rate programs are the ones you can choose the amortization of the loan, whether it be 30 or 15, 10, 20. We can actually just, decide whatever the borrower what best fits their needs. But on the adjustable rate mortgage, they're generally amortized over 30 years. Now you can choose different options, 3, 5, 7, 10-year fixed periods, which allow the borrower who doesn't maybe plan on staying in the house for 30 years, that want the benefit of a lower rate for a shorter period of time. It's a great avenue for them to save money on interest and have a lower monthly payment for the time that they think they're going to be in the property.
Now, one thing that we run across once in a while is someone that buys a home and wants to rent it out later. Is that any consequence to them if they bought it as a primary residence and then a year later or two decide to upgrade or move and make that a rental?
No, that happens quite a bit. A lot of people that want to buy their first home or even their second home will eventually decide to rent out the property. At the time of closing, the only thing that they have to sign up front is an occupancy affidavit that basically states they're going to live and occupy the property for at least the first year. After that, they're welcome to do whatever they wish to do with the property. The only thing they would lose would be is their homestead exemption, should they decide to move that to another property they might be moving into. So they only have to worry about is maybe the increased property tax implications on moving their homestead. But certainly after the loan is closed, they're welcome to do what they want with the property.
Can you go over maybe what the closing costs might be for a loan, and is the buyer responsible for paying all of that?
Closing costs can vary depending on the type of program that we're doing, because some first-time home buyer programs, the government does not charge certain taxes that would be applicable to a regular traditional deal. So I would normally say a lot of people like to use a percentage of what the size of the loan is to calculate closing costs. I don't know if that's a really good way to do it, because on smaller loans, a percentage of closing costs is a much smaller number than on the bigger loans. So, but generally I usually hear 3.5%, 4%, depending on the size of the loan, would dictate the amount towards closing. But there's a lot of fixed costs that go into mortgages. So it's really hard to say, is there a certain percentage of what it would take to get a loan closed? There's different obviously different parties involved with including their fees and costs. But I would say on a traditional, if we were going to put a percentage out there, an average size loan amount, maybe 3.5%.
Okay, and can that money come from grandma? Can I pull out my dollar bills I've been saving in the closet?
That's funny. We get that question a lot. We have a lot of people that want to pull money out of their backyard, out of a coffee can. Unfortunately, a lot of the the money that we have to use for closing has to be sourced, and it has to be from an eligible location. So, but gifts from family members are never an issue. Certainly, money from employment, any I don't know what you would say, like maybe money that you received from your employer in regards to vacation that you didn't take on or bonuses. That's perfectly acceptable. The only question I would be leery, or maybe not question, but I would let every borrower know: do not deposit any cash that we can't source, because then we can't use it. So be careful of that, because that makes a big difference. A lot of people might have some money lying around. They deposit the funds thinking that it would be eligible for a mortgage transaction. Unfortunately, it does create some issues for financing, because we have to track where that money came from. And if it cannot be sourced, it cannot be used, unfortunately.
Okay, and so I get approved for my new house. So now I'm going to rush out and I'm going to get new furniture and new appliances and maybe even a new car. How's that sound?
Well, I would say if you won the lottery, that would be great. I mean, certainly I would want to make sure the loan was closed. But yeah, that definitely can hinder a loan closing for sure, especially if the loan's not closed and the loan's certainly not clear to close. Applying for new credit cards, making any large purchases, boats, cars, trucks, anything you can imagine, can certainly turn your loan approval from a smiley to a frown overnight. And so we don't recommend doing that. Even if it's for a free, free same as cash, or you buy it now and you get 10% off your total purchase. Yeah, we don't recommend doing that. It's not worth the risk for sure. But after closing, you're welcome to buy that brand new shiny car.
They always like to do that like 2 weeks before, buy the furniture and everything else to fill their new home, and knocks them out.
It does. It can, for sure.
So,
Okay. Ken, do you have any final questions as we round up this interview?
no, but I do thank both of you for helping me out and asking these questions. These are just a few that we run across a lot. Mark with Guaranteed Rate does a fantastic job. Talk with him. I know you have other packages that you offer that maybe we can touch base with later. This is really for your first time, or just if it's been a while since you bought a home. These are the kind of questions that come up. Percentage wise, I'm gonna throw you a curveball. Percentage wise, right now, do you know how much people are spending from their net income or their gross on their housing in today's times?
Well, I think for the most part, it's ideal to keep more, maybe 45% of your total income for debt. Now, we do see a lot of borrowers spend more than that. So sometimes it's 57% of their total income, 50%. In any case, we will always approve a loan anywhere that we can. We'll never discourage anybody from qualifying if they feel like they don't, or will not get approved for a mortgage. But just be sure that we're here to make sure that home buyers are successful, they remain in their house, and we do what we can to help them if they have any issues.
Perfect. Because that's my pet peeve is you may qualify for a certain amount. Doesn't mean you need to spend it. You want to live in your means. You don't want to be house poor. So thank you for bringing that up. All right. No, thank you both. Thank you so much for being here. Thanks for everything. If you have any questions, feel free to call our office at 813-413-4229. Also, hit the subscribe button below so you can follow us. We're going to have a lot more topics talking about budgeting, finance, investing, and other questions about real estate that may come up. So thank you all and appreciate the time.
And you can follow us on Instagram and Facebook. Just search the Brownlee Group.